Hi guys, this is Professor Marvin, and I'm just going to be doing these short little videos every week as we continue throughout this course, and just kind of give you guys a little introduction, insight into some of the more unique things that are different from what we consider maybe FASB or for-profit accounting that you're all much more knowledgeable about, and so. Here in week 3, we're talking about capital assets and long-term liabilities. And so there's unique things that government entities do regarding capital assets and long-term liabilities. So, generally when we're talking about capital assets of government agencies or government entities, we might be talking about roads and highways and those sorts of things, infrastructure within a state, a city, that sort of thing, or buildings, office space, libraries, those sorts of things. So let's take a look at some of the more unique items here for week 3 as we dive into our capital assets. So the first thing is that we have this capital projects fund, and so there's that phase of the acquisition and procuring, if you will, those capital assets. So how does that work within the different funds within the government? Let's take a look at this illustration, and then let's kind of put some context around that. So the general fund or the special revenue fund used to account for the capital outlay expenditures from the annual budget appropriation. So what was set aside and established within that budgeting process, that's going to kind of be facilitated through that general fund or special revenue fund. Okay. Now in the center, we have our capital projects funds that's used to account for the acquisition or construction of the capital facilities and other assets from financial resources that are restricted, committed, or assigned for expenditure of outlays. So that's where we're going to actually capture those acquisition activities. Then over on the far side here, our government-wide government activities, that's where we're going to use that area for the cost of depreciation and general capital asset acquired by expenditures of the general fund or some sort of special fund, used to account for the general capital assets financed and leased. And so that's where we're going to see kind of that more traditional depreciation being hit as that capital asset is being used up over its useful life. So asset impairment, here in GASB, kind of a similar definition, similar aspect that we would see in financial accounting or FASB. As the book says, the GASB defines an asset impairment as a significant unexpected decline in the service utility of a capital asset. Impairments occur as a result of unexpected circumstances or events such as physical damage, obsolescence, those sorts of things. So what we're seeing there is that there's just this lack of use, lack of purpose for those assets, and in those situations, the value then is called impaired. Just like a handicapped person, right? They're impaired. It's not whole. It's not complete in its entirety. So the other item that's talked about in chapter 5 is bond anticipation notes, and so it's kind of a flip flop here between chapters 5 and 6. But just as the name implies, a bond anticipation note, okay? This is when an entity has a bond that they're going to issue. Maybe they've gotten approval for it, but when the bond actually is going to be issued, there's this gap, and we need some financial help to get us from today to the date that the bond is actually issued. And so what we're saying is so here we are in March, and we're going to issue a bond in June, but we know we're going to issue it in June, but in May we're going to have some expenditures around this this capital asset, whatever that happens to be. And so in anticipation of the bond, we're going to borrow some money, and then we're going to use the bond. Then we're going to use those funds to pay off the anticipation note, and then kind of go from there. So that's kind of the idea behind that bond anticipation. A few more things here on capital assets. So one of the tail end elements within that capital project fund is what's called the interfund transfer, and this is kind of like the shutting down of that capital project fund. So as this example in your textbook describes, the only remaining asset in the fund after the transactions were recorded, as the textbook went through those, was they were still sitting on $6,000 in cash. And so what we're going to do then is transfer that out, and as the book describes, to the debt service fund. And so we're moving it from the capital projects into the fund that's going to actually ultimately be serving the debt of this bond. And so that's just kind of the shutting down of that capital projects fund. One more item here on the capital asset, and then we'll flip over into long-term liabilities, is service concession arrangements rather. And so basically all this is that where the government entity is going to contract out with a company, with usually a for-profit company, and contract out kind of that administrative function role of kind of maintaining a given asset. So in this example in the textbook, it's about a private company might pay a large fee to a county in exchange for the right to operate a parking garage. Okay, so if you think about a parking garage, it's built, it's established. If all we have to do is operate it, and basically, kind of have somebody there to collect the gate, or put in a machine and kind of operate that, with Apple Pay and that sort of thing. A company would be really interested in doing that. Now, well, why would the government be willing to kind of give that up, right? Well, it's that whole transaction, right? So if they're interested in maybe collecting that fee so that they can then do something else with that, it kind of front loads up that cash flow that they're going to be getting from the parking garage over the next 20 years. They're ultimately going to get the parking garage back at the end of the 20 years. So what they're kind of doing is what we'd maybe say called monetizing that. So they're putting that cash flow into their pocket today, and then they're able to redeploy that now versus getting part over the next 20 years. Okay. So that's kind of, and again, different transactions all benefit different people different ways, right? And this type of an arrangement is very similar in that regard. Okay, so just a couple on the long-term liabilities. I didn't feel that there were a lot of really unique or kind of abstract ideas here in Chapter 6, but a few. So the first one is this idea about a sinking fund. And so basically, early on, or the traditional bond structure is that a government is going to issue a bond. So what that means is we're going to borrow money from the people that want to buy that bond. So if I am the Tiffin University, okay, Tiffin University can issue a bond, or the city of Tiffin, or York County, or whatever. Okay, so we want to borrow money. So what we're going to do is we're going to get $1 million from all the people that want to borrow, that are willing to lend us the money, and so we're going to collect $1 million through the issuance of this bond. And now we're going to guarantee to pay them back over a period of time or at a specific time. Okay. The traditional bond was that we're going to borrow this $1 million. We're going to pay you interest each year. Maybe we're going to split that interest payment up and pay you part in June and part in December, but we're going to pay you interest. We're going to pay you interest. We're going to pay you interest. That's going to continue for 10 years. And then at the end of the 10 years, we're going to give you your $1 million back. Okay. And so that was the traditional bond. And so the fact of the matter is that on that back end, or as the book describes that balloon payment, that back end payment, the sinking fund was just a way for us to save and plan and be ready for that $1 million on the back end. Okay. And so that's how a term bond would work. And let's take a look at some of these definitions here around term bonds. So term bonds, it's issued, they mature in its entirety on a given day. Okay, so that's what we just went through. Okay, so that's where we're probably going to have that sinking fund, or possibly have that sinking fund where we're going to save and kind of save and set aside, and then we're just going to pay that $1 million on that balloon payment date. Okay, now there's also what's called a serial bond. And so instead of having the $1 million come due in 10 years, basically a serial bond just means that it's going to be maturing in installments. So maybe it's, if we have that $1 million, maybe it's 100,000 each year. Maybe it's stair-stepped, but also what we have here is basically 4 different types of serial bonds: regular, deferred, annuity, and irregular. So irregular, we'll get to that in a second. That might be that stair step that I was just talking about. But a regular series bond is where it's just, $100 grand, $100 grand, $100 grand, boom, boom, boom. There they go. There's your $1 million on the end of that 10 years. Okay. Equal annual installments. Do. Okay. If the first installment is delayed for a period of time, but then the other ones fall into a regular basis, a regular time schedule, then they're known as a deferred serial bond, right? We're deferring that first payment. Okay. If the amount of the annual principal repayment is scheduled to increase each year by approximately the same amount, right, on a serial bond, just like a mortgage or a car loan, if we're paying down and paying down and paying down, if we're paying off 100 grand and 100 grand and 100 grand, then the interest is also going down, right? Because if we have $1 million of debt and it's a 10% loan, no, interest rates are so much lower than that. So if it's $1 million bond and the interest rate is 3%, right, then we're going to pay 30 grand in interest, right? But then if we pay down 100 grand, well, that means our interest payment is going to also go down, right? As our principal drops, so does our interest. And so if we keep that more at a constant, then that's where we see that annuity serial bond come into play. So that it's kind of like that constant. That's what all that's saying is that the repayment is scheduled to increase by approximately the same amount that the interest payments decrease. So even though the interest is going down, we're kind of keeping the payment steady, and so that's going to create kind of continuity between those years, and so we have that annuity